What is up? This is the Working Investor. In this video, we're going to review a strategy called FUGLY. It's an acronym, FUGLY. And this is an income fund that one of my friends who's very smart, his name is Axel, had come up with. Shout out to Axel. For those who like weekly income, high yield income, and have no single stock risk, and have a little bit of a hedge, this setup may or may not help. By the way, everything here is not financial advice, legal advice, tax advice, or any form of advice. This is for fun and entertainment purposes only. Please take your own risk and see who you need to see and speak to who you have to speak to. So let's break down this strategy of the 5 components. So it's basically equally weighted 20% into each of these 5 holdings. And I spoke with Axel, may not have to be your entire fund. It could be that 90% of your fund is your traditional investing, and maybe 10% is a little bit like a degenerative move, and you just want to have like a crazy income from the 10% of the portfolio. Then you could subdivide that 10%, 2% into each of these to have a little fun. So fiat is an inverse Bitcoin. So it's basically the inverse coin ETF. That's why you see it upside down Bitcoin label. Alti has a whole bunch of stuff, including small caps and triple leverage products. So hence the small baseball caps. GPT, and they change all the time. They've been changing all over the time. It's hard to keep up. It's a moving target. GPTY is basically a thematic fund that's on AI, like GPT. LFGY is a whole Bitcoin, ETF with a whole bunch of holdings. And YMAX, some people may call it holding the bag, which have many bags inside as a joke. So that's just like all the single stocks go into this big bag, and that's what YMAX is. And therefore, this strategy needs strategic rebalancing. So when something is overweighted, it's time to slice off and put it aside, or put it into the one that's underweighted, and vice versa. Not necessarily do the dividends have to be reinvested. They get put aside and evaluated on a week basis if they do get reinvested or held to the side. That's the idea of the fund. So you're not really betting that the market's going to go one direction or the other. You're kind of saying mostly it would go okay and sometimes not. And another wrinkle is that, YMX has supposedly all these different sectors and themes. So if there's money cycling through different, international or gold or, Magnificent Seven or whatever, it will cycle somewhere in the YMAX, possibly in the space. Though it does have, you do have cover call, synthetic cover call, a lot of risk. Look at all the prospectus, a lot of risk in all these underlyings. And then the GPTY, LFGY, ULTY, according to what I understand when I read through the prospectus a couple of times, is that they basically can do all kinds of strategies, and they do tend to hold the underlying a lot of times. And also they do like collars. They try to cap their upside. I remember Jay talking about that they try to cap their downside. So they're kind of like hedged in a way. I personally, don't have Ulti right now, but I do have the other 3. And I don't have fiat at the moment. I did have it in the past. And the idea is that fiat would, kind of work as a hedge. The question is, why fiat as the inverse? Why not winter, which is the WNTR, which is the inverse MSTR, right? Or other, dips or crash, from or YQQQ. So though they're all good options, but speaking to Axel, he was saying very interesting that fiat is a cross section between fintech, financial technology. Coinbase is a financial technology company, and also they have some correlation to Bitcoin. So it cross-sects many different things, though obviously not as thoroughly as the NASDAQ. It depends what you're trying to hedge against. You know what I mean? So if you're trying to hedge against Bitcoin, about 14-15% of ymax is Bitcoin, right? LFGY is Bitcoin. GPTY has a lot of Bitcoin-ish sort of, or funds that have Bitcoin exposure. OT, I'm sure, has some Bitcoin in there. So there's a lot of, possible, hedge, but it's not necessarily you have to be predicated on this, but that's just an idea. I personally am not in this strategy. I'm just here to share it with you to see what you guys think about it. Do you guys think it's a viable strategy or not? So let's continue on. Let's look at the brass tacks and do a little back testing. So I'm going back to January 24th, 2025. I want to go back further to get the most data, but unfortunately the newest fund, I think it was GPTY, came out on the 23rd. So basically I want to make sure I encompass everything, to have a good shoulder-to-shoulder comparison. So I'm going to add up all 5 funds total return and do an average. So you could see when you add them up, it comes out to negative 43.83, and then you divide it by 5, so you get you can't see it, but it's negative 8.766 in total return. If you want to compare it to the VU is down in total return in the same period of time, negative. If you're 100% VU, it's negative 15.21. So it fared a little bit better than VU, but this is a short term. You really want to see 3 to 5 years at least to see some real data. As you guys know, if you've been following me, that I've actually tried every single yieldmax hedge inverse fund except for YQQQ and Winter, which came out recently, and I've tested them out in all different ways, and I have my reasons why I don't consider them the best type of hedge. I'll send you the link so you guys could see the video. So why do I find this as a use case to some people who are really adamant they want to have extremely high yield dividend income, which does have a lot of risk, is that, like a lot of people, I initially went after the income heavily, better than my greater judgment, without using classical portfolio management. And it's very important to have classical portfolio management, which you have a well-diversified fund and you're hedged out, so you could bear certain various market conditions, like some commodities, precious metal, fixed income. Other, you want to worry about whipsaw, so you want to have some funds that don't have capped upside against the funds that do have capped upside. You want to have a balanced, hedged out portfolio. You need to be your own hedge fund manager. You don't want to be going down a race car full speed ahead. Yes, you'll get there really fast, but you're not going with any airbags. You're not going with no seatbelt, no helmet. So yeah, you can slam the gas all the way down and get somewhere really fast, but you can end the game really fast by crashing. So you want to have those seatbelts and you want to have those airbags and all the safety stuff in order. Like, for example, I have LFGY, and you can see it's down total return, in this period, 26%, YMAX 17% in this period of time, GPTY 22%. Had I have this whole mix, not sure if I would buy OT, but if I had this whole mix, with the fiat counteracting it, even though it's not a perfect hedge, it did do obviously some good. And it would turn this 22+% down, or 30% down in my case, to maybe a negative 8 point something percent down, right? But of course, this can also be recency bias, and I really want to test this out in a long-term test. I do track it every day or every other day. So here you could see I have a special watch list just for the FUGLY. I may stop tracking it after a while, but I do notice that, it doesn't go sometimes as high up on the up days, but it doesn't go as far down on the down days. So time will tell. I would be more convinced if I had a positive total return, but you have to think about it, only 20% hedge, and it did a massive impact on reducing that heavy drawdown to like S&P 500 levels or lower. If you guys remember, I am comparing this also to my triple alpha hedge strategy. This is basically a growth play, not really an income play, where I'm using strategic rebalancing with some triple leverage underlyings that are opposed to each other at times, and they all have positive drift. And I have a lot of hedge. I'm trying to target around 20% positions in commodities, gold, fixed income, real estate, all kinds of stuff that can withstand different market environments. I will keep you updated with a risk adjusted return type of strategy where we want to go for good, decent amount of, reward, maybe meeting or surpassing the S&P with limited downside. I mean, that's where, who doesn't want great upside with limited downside? I'm sure a lot of us are looking for that gold at the end of the rainbow. So I'll keep tinkering, keep working on some keep bumping ideas off some friends and try to come up with some great ideas to put out there. Just some stuff, some food for thought for you to talk about with your financial advisor and whoever you have to speak to. If you stay to the end, I will share with you what kind of I'm holding in my degenerative account where I'm trying to do some redemption. So today, of course, was a good day, but that's easy to talk about a good day, up 10.57%, but everybody's up. I don't believe this pop. I think it's a fake out, but this is what I hold right now. So I have, 5,800 shares of YMAX, 740 shares of AIPI, RDTE, GPTY, SPY-I, LFGY, T-SPY, XTT. This is, you see I have different S&P 500 0-day to expiration and 1 monthly play because I'm doing parallel diversification, which is something I'm testing out. And I have SDTY. So yeah, I could drop you the link for that parallel diversification strategy. CLOZ, basically it's a CLO, YGLD from Simplify. So here I'm starting to build up my hedges. So I have some CLOs. I'm using the proceeds of my dividend. My strategy is I stop drip for now, even though the market's, obviously the market's popping, so it's okay to stop drip. But I'm using the dividends to build up at least 1 to 2% of my portfolio with these hedges, each of these hedges at least. And I may find other hedges or build these up further to try to basically give myself some resilience. So CLO, some gold, which is interesting. I have a video on that, how they do put credit spreads on equities, and they have 1.5x long gold. Very interesting strategy. IYRI, which is NEOS, and I have a video on that comparing. This is from the REITs. CEFS, I have a video on that. I have a lot of videos, almost everything. BIZD, which is business development company. CEFS is closed-end funds, which in itself is a whole basket of funds. CTA, from Simplify, it's managed futures. So these are some hedges that I'm building up right now. On the option side, part of my exposure to Bitcoin is having IBIT. I have these 2 long call leaps, and I did see that Bitcoin pop today, and it's actually popping now in the overnight hours in the 90,000 range. So I did sell 2 poor man cover calls above my cost basis that expires in the end of May. And I did roll down my put, my $58 put to $55, made $130, and I used that to buy more hedges. I have played around with inverse hedges as well, but I tried not to short the market long term. It's just not my style. It's a great idea, but just I don't feel too super comfortable. I may do it here and there, in and out, but I'd rather have hedges that are always available, always there, even if it's a small percent, but it does damper the downside a little bit. Anyways, let me know what you guys think of the FUGLY strategy. Do you like it? Do you hate it? Do you think it has a use case? Does it can help a lot of people or not help anybody? What are your thoughts? Anyways, this is the Working Investor over and out. I hope you guys have a wonderful trading day.